Welcome to The Explainer. Today we're tackling a really big question. How do you actually protect your wealth when holding on to cash feels less like a safe bet and more like, well, a guaranteed loss? We're going to break down exactly why this is happening and then explore the kinds of assets that can act as a financial lifeboat when things get rocky.
So let's just get right into it. The problem we're talking about today isn't some brand new thing that just popped up. Look at this quote from the Wall Street Journal. It's from 2011. For well over a decade, the official policies meant to juice the economy have had this punishing side effect for regular people just trying to save their money. This really highlights the key point. Holding cash isn't just unproductive anymore. It's a position that's actively working against you.
And that really brings us to the central question for this whole explainer. I mean, if the old rules, a penny saved is a penny earned, just don't apply anymore, what are the new rules? How do you position yourself not just to survive, but to maybe even thrive when the very idea of money is being challenged? That's what we're here to figure out.
To get to the bottom of that, we've broken this down into 5 parts. First, we're going to really diagnose the problem, the crisis for what we think of as safe cash. Then, we'll talk about a crucial shift in perspective, adopting an investor's mindset. From there, we'll dive into 2 huge categories of assets, tangible ones and paper ones. And finally, we'll pull it all together with the most important part, your risk management toolbox.
Okay, so let's start with the immediate threat. A lot of us were taught that cash in the bank is the ultimate safety net, right? But what we're about to see is that safety net is more like a leaky bucket and is constantly dripping value whether you notice it or not.
So here are the 2 culprits right here, inflation and rock-bottom interest rates. Think about it. On one side, you've got the teeny tiny interest your savings account might earn, if you're lucky, and on the other, you have the massive weight of inflation, which is just the rising cost of, well, everything. When inflation is heavier than your interest, your savings get crushed. This isn't just some theory. It's the reality that your money is losing its power to buy things, day by day, just by sitting still.
And this gets a name. It's called purchasing risk. It's like this silent thief that just eats away at your wealth over time. Think of it this way. Maybe years ago, $1 could buy you a gallon of gas. Today, you still have that same dollar in your hand, but it might take 10 of them to buy that same gallon. The dollar itself didn't change, but its power, its ability to purchase, absolutely did. That's purchasing risk in action.
And this decay over time, it is very, very real. What $100 buys you today is just not what it's going to buy you in the future. I mean, in just a decade, you could lose almost 1/3 of your purchasing power. And this isn't some dramatic market crash you see on the news. It's a slow, quiet, steady drain on your financial security.
So it's really important to understand that this isn't just some natural thing that happens. It's often a direct result of policy. When central banks use tools like quantitative easing, or QE, they're basically pumping huge amounts of new money into the system. And when you flood the market with cash, it dilutes the value of every single dollar that's already out there. It forces people to take their savings out of cash and put it into other assets just to keep from getting washed away.
Okay, so we've diagnosed the problem. Now we need to make a really important shift in how we think, moving away from a saver's mindset to an investor's mindset. This is the absolute foundation that all wealth protection and growth is built on. It's a completely different way of looking at the world.
Let's start with the most basic but most powerful definition made famous by Robert Kiyosaki. An asset puts money in your pocket. A liability takes money out of your pocket. It's that simple. A rental property that gives you cash flow every month, that's an asset. The house you live in that costs you a mortgage, taxes, and repairs every month, that's a liability. The whole game is to use your money to buy more assets, not more liabilities. So how do you actually build up that asset column? Well, it really comes down to 2 things. The first is buying power. That's your ability to actually go out and get assets. And it's not just about having cash, it's also about using credit smartly. But buying power without the second pillar, financial education, is like giving car keys to somebody who doesn't know how to drive. It's dangerous. Education is the knowledge that lets you spot good assets and manage them right, turning that buying power into actual wealth.
Okay, with that investor mindset locked in, let's explore our first big category of assets. Tangible assets. Think of these as the real, physical stuff you can actually hold in your hand. They can act as incredible anchors during a financial storm.
So the main players here are things like real estate, precious metals, and commodities. With real estate, the strategy is all about cash flow, often by using the bank's money, what some call good debt, to buy a property that pays you every month. Then you have precious metals like gold and silver, which for centuries have been a store of value when paper currencies get into trouble. And commodities, Well, that's just the essential stuff of life. We're always going to need food, oil, and lumber, which gives them a real, lasting value. And this quote it nails the core strength of tangible assets perfectly. A business, no matter how big and powerful, is an institution. It can fail. Its stock can go to zero. But gold is just gold. It's an element. Lumber is wood. These things aren't tied to a CEO or a balance sheet. They are simply stuff with their own built-in value, and that makes them a powerful form of financial insurance.
All right, now let's flip the coin and look at the other side. Paper assets. While tangible assets give you that solid, heavy anchor, paper assets offer something completely different but just as valuable: agility, and the ability to thrive when markets get crazy.
Paper assets are what most of us think of when we hear investing, right? You've got stocks, which is just owning a little piece of a company, bonds, where you're basically acting as the bank and loaning money out, and then more advanced things like options, which are contracts that give you incredible flexibility. The big difference here is that these assets are super liquid. You can turn them back into cash almost instantly.
And this right here is the superpower of paper assets. With a physical asset, like a house, it's really hard to make money if the market for houses is crashing. But with paper assets, it almost doesn't matter which way the market is going. An educated investor can use strategies to make money if the market's going up, down, or even if it's just chopping around sideways doing nothing. That kind of agility is a massive, massive advantage in an uncertain world.
And this brings us to our final and honestly our most important section. See, owning assets is one thing, but protecting them is the whole game. It doesn't matter what you own, tangible or paper, if you don't have a system for managing your risk. This is the pillar that holds everything else up.
First, we've got to know what we're up against. There are basically two types of risk. Non-systemic risk is something bad that happens to one single company. Maybe a CEO gets fired and the stock tanks. You can protect yourself from that by diversifying, not putting all your eggs in one basket. But systemic risk, that's different. That's when the whole system is in trouble, like the 2008 financial crisis. It hits everyone, and simple diversification isn't going to save you.
So if diversification can't protect you from that big, systemic risk, what can? The answer is hedging. And honestly, the best way to think about hedging is that it's just like buying insurance for your portfolio. You can't control whether a hurricane is going to hit your house, right? But you can buy an insurance policy to protect you financially if it does. It's the same with your investments. You can't control a market crash, but you can use a hedge to protect your portfolio. The rule is simple. If you can't control it, you hedge it.
Here's a fantastic way to picture how a hedge works. Think of a financial teeter-totter. Imagine the US dollar is sitting on one side. If you're worried that the dollar's value is going to go down because of inflation or government policy, you put an asset like gold or silver on the other side. The idea is that as the dollar falls, the value of gold tends to rise, keeping your overall financial position stable. It just neutralizes the crazy swings.
And hedging is just one tool in a much bigger risk management toolbox. A full strategy includes smart asset allocation, knowing your position size so you don't risk too much on any one idea, using things like stop-loss orders to automatically get you out of a bad trade, and maybe most importantly, always having an exit strategy before you even get into an investment. These are the things that separate the pros from the amateurs. And that really brings us to the end. The biggest thing to take away from all of this is that financial crises are not a matter of if, but when. The world is always changing. Markets are always moving. The only thing you can really control is your own preparation. It's not about being able to predict the future. It's about being positioned for whatever the future might hold. So the final question really is, are you?